Wharton School professor of finance and WisdomTree's chief economist, Jeremy Siegel. Professor Siegel, what was your take on the report today? Obviously came in line as expected, but year over year, inflation at the headline up 2.9%, still above the Fed's target rate.
Yeah, most certainly. But the news was good. It hit all the targets. Nothing, no upside surprise. And yesterday, strong economic data. I think that both on the trade deficit going down and on the durable goods report. And I think all forecasters have now raised their GDP estimates for the third quarter. So with tame inflation, stronger real growth, I mean, these are all good signs for the stock market.
And so you would call inflation tame because of the month-over-month number?
Well, yes, the month-over-month number, and I do expect the tariffs to cause a bump in inflation. But I think that the Fed has to look beyond that because tariffs are really like a tax. And, that's not a sign that there's too much demand for goods in the economy. That's what the Fed has to look out for. Too many people want to buy things that are in short supply. But if prices go up because of a tax, that's something that the Fed should back away from. So the tariffs, I actually think the inflation numbers are coming in better than I and most others had anticipated.
So earlier this week, it was a couple days ago now at this point, I think Michelle Bowman made some comments about thinking the Fed should actually de-emphasize inflation. What do you make of those comments?
Yeah, I mean, I think because of how much is going to come from tariffs, that's a noise that we don't know. And as a result, is that the information in the inflation news about permanent inflation, what the Fed should be concerned of, is not as good. Yet now we have the data on employment. There's been a lot of question about how good is that data, but at least that doesn't have the same type of problems with a tax on it the way that we do with the goods on the inflation front. Of course, we all know the government shuts down that all-important employment report Friday. Are we going to get it or not? I mean, next week is an important week. Last week of the month, a lot of data comes through. Let's hope that we can get a settlement there.
Yeah, absolutely. That is something that would be sort of key for the market and investors that we would lose if the government does indeed shut down or stay shut down for that long. You mentioned GDP. I'd like to circle back to that. We were talking about tariffs on goods, but the GDP numbers for services, I mean, pretty healthy spending there as well.
Yeah, I mean the GDP. Now we had a big increase in the estimate on the second quarter, but remember the first quarter was negative. So actually, the first half of this year was under 2%. Now Atlanta Fed thinks this third quarter is going to be in the high threes. They tend to be a little bit optimistic. Goldman Sachs thinks it's going to be sort of in the mid twos. That's still decent growth. It's not runaway growth by any means, and I really think this fourth quarter is a real test for the whole tariff hypothesis because we know how much retail spending goes on in December with the holidays. The firms, I think retail firms make all their profits in the month of December and hold even barely on the other 11 months. So we're going to really, I think this fourth quarter coming up is really going to be the important tell about how much do tariffs really going to impact consumer spending.
Absolutely. So then in the meantime, before the Fed is armed with any of that information from retailers and from the full impact of tariffs, we think they're going to cut. I mean, it's very, very rare, only a few instances, I think, in history where the Fed cuts and then pauses for a while. So we think the cuts are coming. But does it feel appropriate to just stay with 25? Is 50 off the table at this point? What did they do in the vacuum of information about the impact of tariffs that's still, we believe, not fully baked?
Well, I think there's three things that argue for a continuation of the cut. Certainly, payroll growth has come way down. I mean, the estimates for next Friday are only 50,000. Remember, we used to be 150, 200, even 300,000. And also the fact that in general, short-term interest rates should be about a percentage point below long-term interest rates. And we have the 10-year at about 410, 415, and that does argue for trying to target the low threes on that. And furthermore, variable that I always look at, money supply growth has been sluggish. which means that I don't see really that this is anything like an inflationary surge that we saw in 2001 and 2002 that got the Fed and the economy in so much trouble. So for those three reasons, I think a 25 basis point cut in the next two meetings is still appropriate.